Hi, my name is Andrea Carpenter, and I'm a financial advisor here with Prosperity Partners Wealth Management. And you may be having some concerns about investments in your retirement portfolio amid today's global uncertainty. Today, we want to offer some context and some reassurance about some of these events and some things to think about moving forward. First, we want a quick review and give some perspective in similar types of events. And no doubt the Russian attack on Ukraine poses a large global threat. However, it's important for American investors to know that we have a resilient economy and that historically holds steady through similar types of crises. We can look back at some of the things that history has taught us about these past conflicts, and historically they've not adversely impacted the markets over a long period of time. Just looking at a handful of examples, such as the JFK assassination, the Cuban Missile Crisis, the attack on Pearl Harbor, and the like. Look at the number of the total drawdown in the market, the number of days, but then the one-year calendar returns that we can see and point to. Some of these most extreme examples we see is that while corrections and bear markets are painful, they are part of investing, and we've rebounded significantly at times such as these, and those who've stayed the course have been rewarded. Staying the course can be tough, but it is the best way to weather these types of storms. 5 keys to keeping your financial cool and looking at those action plans that we want to talk about today. The first one being invest with intelligence and not act emotionally. Typically, the best course of action during periods of market uncertainty is to stay invested and don't make a knee-jerk reaction. Don't attempt to time the market. Brace for those short terms of turbulence. The market reaction typically during these times is swift, followed by a swift recovery. Keeping your eye on your long-term goals and plans is paramount. Diversification is exceptionally important to keep your portfolio balanced and to protect against the unknown. I'll mention just a few more things about this and how that makes a difference. Remembering also that bear markets and corrections are common and potentially can be healthy over the long term. Only 6 of the last 94 years have experienced a market downturn by more than 20%. That is significant. And in those times, patience can help us win in the long term. And we need to allow those market swings to play out as part of normal investing, even if we don't like to see that. And then 5, buying low and selling high. It's an old adage, but for some reason when we have times of uncertainty, people forget that and they tend to think they need to sell low and not see this as what it can be, which is a buying opportunity to look for sectors or different areas that may be good times to invest and to look at. Looking at those short-term turbulences, those short-term events that I mentioned, looking back from January 1 to December 31st, this is a great piece that talks about inter-year, what happened when the market ended its calendar year returns, as you see in blue, and then those inter-year declines. Look at the fluctuations and swings, and if you did exit the market during those times of turbulence, what you would have missed out on if you had not stayed invested. And following your emotions is never a good thing. Remaining diversified is extremely important because, frankly, it's the most important way to maintain your sense of equilibrium, calm, and safeguard against things such as inflation. we look at things during times like this, such as rebalancing. Market highs and downturns are great times to do that. Inflation proofing your portfolio and assets and looking to make sure we have things built in for that. Being aware of the lack of liquidity in certain assets or exposure. Looking for other areas, such as considering looking at protected options such as annuities or structured products that might dampen that volatility during these times of uncertainty, and how we can tactically do that. During downturns over the last number of years, like I mentioned, down 20% or more, just 6 years in the last 94. That's significant. One of the things that we all want to try to do is pick those best days. And if we knew exactly what the market was going to do, we wouldn't have to try to go through the same process. But timing the market has never been a strong strategy. One of the things, if you look at just going back here, decade after decade, if an investor had missed the best 10 days of the market and remained invested, look at the bottom line there, the total overall return if they had chosen to get out, how much they would have lost. A cumulative return of over 17,000% versus 28% if they had gotten out early. Our emotions tell us one thing, but it's very important to remember, what are my goals for these funds? What are the things that I'm planning to do and trying to accomplish with the monies that I have? And the best thing that you can do if you're feeling anxious, if you're feeling uncertain, if you have questions, simply reach out to us. If you have a question, we would rather you call us and talk to us about it than worry and have a concern that we might be able to alleviate quickly. If there's something about your situation that's changed, that's something we want to talk to you about as well. We always want to focus not on necessarily the investment directly, but how it relates to your specific situation at all times, and how things that are going on now impact that before we make any changes. Let us address your concerns. You can reach out to us. You have our office number there. You can reach out to us, send us an email, get in contact. As always, we thank you for your time, and we hope that this time is valuable, this information is helpful, and gives you some perspective on some of the things going on in today's market and world. Thank you.